Hello class and welcome to our today's lesson. In our today's lesson, we are going to discuss about the double entry bookkeeping, whereby we shall understand how do we record the accounting transactions in the books of accounts. To start in that particular chapter, we shall have to look at the source documents. Source documents are those documents that act as evidence in the business that a particular transaction actually took place. They are the documents that are collected, recorded, filed, and posted in the books of prime entry, which is also known as the books of original entry. If I can give an example on that, there are things like the receipts. Once you pay an amount of money for a particular transaction, you are normally issued with a receipt. That receipt is simply a source document because it will act as an evidence that a particular transaction actually took place in the business. In the same case, we have got quite a number of books which actually act as evidence of transactions happening in the business. One of the source documents we have in the business is what we call the sales invoice, also known as the outgoing invoice. An invoice is a document that is issued by the seller to the buyer when the buyer buys goods on credit terms. So, when a business sells its goods on credit, the customers who buys the goods are normally issued with the invoice, which simply specifies the goods that were bought plus their descriptions and the total amount that the buyer is supposed to pay. Of importance here, you need to know that an invoice is prepared by the seller. And therefore, the person who is now receiving that document is now going to be the buyer. It is known as outgoing because it is moving out of the business to the customer or the buyer. Here, we are using the word debtors. Debtors, they are simply credit customers. Anytime a business sells goods on a credit, the person to whom those goods are sold is known as a debtor. Note that a debtor is simply a credit customer. So it is this particular debtor or credit customer who is receiving that particular invoice in the case of the sales invoice. And therefore, all the sales invoice that will be issued in a particular financial period can be totaled, and then the business can be able to know the total amount of credit sales that were made in that particular period. Similar to the sales invoice is what we call the purchases invoice. Purchases invoice is also known as the incoming invoice. As I said, an invoice is prepared by the seller. In this case, the business is purchasing the goods, therefore it is receiving that invoice from the person from whom those goods were bought from. It is incoming because we are receiving it. And therefore, a purchase invoice is sent by the creditor, who is actually the supplier or the seller, to the business for the credit goods that were purchased in that particular date. So, the difference between the sales invoice and the purchases invoice is that in the sales invoice, it is the business that is preparing those invoices and sending them out to the customers who bought goods on credit, and that's why it is known as outgoing. On the purchases invoice, it is incoming because we are receiving it from the seller, who is actually the supplier. In this case, the supplier is known as the creditor. The supplier is known as the creditor. So anytime in accounting we come across this word creditor, a creditor is a supplier to our business who gave us goods on credit terms. And therefore, all the purchases invoices issued in a particular period, if they are all totaled, they will give us the total amount of credit purchases that we made in that particular financial period. Another source document is what we call the credit note. A credit note is sent to the buyer in response to some goods that were returned. Once you sell goods to your customer, the customer might find those goods not what he had specified. If those goods are not what he had specified, he will return them. The moment he returns those goods, we are supposed to issue as a business a document we call the credit note, which is supposed to reduce the amount that particular customer was supposed to pay. You will find in other books they say that a credit note is used to correct an overcharge. An overcharge will arise when the goods have been returned. When the customer returns the goods, it simply means that the invoice that the customer received is not going to be the invoice the customer is going to pay because some goods have been returned. Therefore, that amount in the invoice needs to be reduced. It needs to be reduced as per the credit note that has been issued by the business. And here note that the credit notes, they are of two categories. We have the incoming credit notes and the outgoing credit notes. The outgoing credit notes, they are meant to reduce the sales invoice, whereas the incoming credit notes are meant to reduce the purchases invoice amount. Another document that we call a source document is a debit note. A debit note is normally issued to correct an undercharge. When you find that the invoice that was sent to the customer was actually a lower amount than what is supposed to be paid, then the business can send a debit note, which is also known as an additional invoice, to increase the amount in the original invoice for that particular customer. Then we have a receipt. A receipt is a document that is issued whenever the business receives cash or checks. Anytime the business receives cash or check, you will find that it will have to issue a receipt. So a receipt is normally issued when cash is involved, but if it is credit, then it is going to be an invoice. Another document that is used is known as the checks. And a check is when a business is paying its transactions via money in the bank, and the business needs to write a check that will be presented to the seller in respect to the amount that particular person is supposed to pay. That particular check will be taken to the bank to be honored for those payments to be effective. You will find that those checks can only be honored if we have got certain conditions which are fulfilled, like the person who is paying the money has got sufficient amount of money in his or her bank account to pay that amount that is supposed to pay. You also find that that particular check does not need to be stale and other conditions. You will find that once a check is not issued, if it is the business which is paying, we have the counterfoil which will account for all the checks that have been issued, because the counterfoils will have similar details to the check that has been issued. We also have a source document we call the petty cash voucher. And a petty cash voucher is simply a document that is normally prepared by the business to confirm that certain expenses have been paid. That is to say, some expenses, it is very hard for a receipt to be issued. Like for example, if the business has sent somebody somewhere and therefore that particular person who has been sent has been given transport money, it might be a bit hard to account that amount of money because that amount of money will not be issued with a receipt. In that particular case, the business can prepare a document we call the petty cash voucher. And a petty cash voucher, it is simply a document that is prepared by the petty cashier who is in charge of the petty cash, and then the person who receives that amount of money is compelled to sign so that that particular amount can be accounted. We also have another document called the delivery note. And a delivery note is a document that is normally issued by the seller to the buyer, and it normally accompanies the goods so that whenever the buyer receives those goods, he can counter-check the details in the delivery note versus the goods delivered so that the business can be able to confirm whether the goods have been delivered the way they were sent by the seller. Thank you very much.